Welcome back in, ladies and gentlemen. We're going to talk about two stocks here that have recently reported earnings, and we're going to go over what my thoughts are, because I do think Intel's earnings were fairly confusing. Definitely some good, definitely some bad, but I wouldn't say there's anything horrific anymore with Intel. I do think Intel's finding a bottom. Now, with that being said, I think the price volatility can go anywhere right now, especially in such a massive downtrend. We could see new lows. But from a fundamental analysis here, I do think things are going to get better as we get through the end of 2025 into 2026. So we're going to go over Intel. We're also going to talk a little bit about UPS. This had a recent fall down here, and I did my analysis on UPS. Now, they're losing one of their largest customers as the stock falls on two major reasons here. Number one, Amazon deal is now getting slashed in half. The CEO actually came out and stated that this should not have a material impact on top line revenue and actually should grow margins because they don't make a lot of money off of the shipping on Amazon products. And the 2025 outlook is falling short of expectations, and the stock got hammered for this. And this was already trading at a decent valuation. Now, the concern I do have with the company is that dividend, but let's start off with Intel first and foremost. Earnings for the fourth quarter were a slight beat. They attribute that to a fear of tariffs. There was an excess of orders placed, and so that definitely benefited their earnings. Problem is, when we look out forward guidance here, they're forecasting for 11.7 to 12.7 billion, expecting first quarter EPS attributed to Intel at negative 27 cents. The street was looking for over 12.7 billion, and it was looking for better expectations on earnings. But the thing is this. First quarter is usually soft for a lot of these companies. And what are we starting to notice with Intel? Well, everything was down for Intel. The one bright spot is their Next, and that was up 10%. Now that is their smallest of all their revenue sources. We don't like to see that, but when we come down to a year over year, the revenue was down 2%, but we see here that every aspect of their business was actually up. So I believe we're starting to see a bottom here in Intel, that the ship is starting to turn. Now, it hasn't made the corner quite yet, but we can see here that maybe the worst is behind us because there are some positive things to actually look at for Intel. What we're starting to see here is CCG starting to stabilize. We obviously know there has been a lack of PC demands, but I don't think that's going to last forever. DCAI is also stabilizing. And then when we look at Next growing, we're starting to see here that Intel is really not in a bad position, especially if PC demand picks back up. This is going to be a nice tailwind for the company. The other thing I want you guys to think about is this. Foundry lost negative $2.3 billion, but when we go over the last few quarters, this seems to be stabilizing as well. Not only is this stabilizing, but Intel received $1.1 billion in the fourth quarter from the CHIPS Act, and they are receiving an additional $1.1 billion for the CHIPS Act in January of this year. So not only are we starting to see the business actually stabilize, we're starting to see government backing them up. They're getting their expenses under control. And there is some positive things that can come here with a possible strong PC market around the corner. Mobileye profitability is improving, and they're going to be producing the 18A volume production in second half of 2025. Now, when we go to the earnings call, no CEO talked about, which is telling me one thing here. The fact that they didn't mention that they have any CEO interest in the call could mean to me that there is still a merger possibility here, and that could be the focus of where Intel is going. And if we look at Intel's revenue stabilizing here, we look at the money that they're receiving from the government, we're seeing here that Foundry is not losing as much money and could be turning a corner. There's multiple reasons to think that this could be undervalued at this level. Now, we're seeing some pretty interesting volatility in the stock today. I mean, it got as high as $20.50, shot back down to $19.50, now climbing back up to $20, now back down to... So this thing is going to be pretty volatile here. But when I look at what's taking place, I do think there is a bottom forming here. And I've done analysis on Intel, and I think you need to look at this stock multiple ways here. Now, personally, I'm thinking between $17.50 to about $18 a share could make sense for the company. This is trading underneath book value, which means that if they completely liquidated here, you would actually have some equity. And I have a future price sitting close to $40 a share. Now, this is with them growing very slow revenue and actually still burning some cash here. But what it looks like is they're going to be breaking even next year. So they're actually achieving a little bit quicker than I anticipated. So that is pretty good news. The other thing is, they guided for next quarter, and this is why we're seeing the stock being volatile. Anybody that bought Intel on the hopes of a merger obviously got a little disappointed here. The stock ran up to over $21 a share. And I think after the earnings and the guidance of them pretty much doing nothing next quarter, it left a sour taste in short-term investors' mouth, and they sold out today, and I think we're going to see that volatility still go throughout the day. And over the next few weeks, I think we should be either A, hearing about a merger, or B, a new CEO that could be taking over the company. So there should be some positive catalyst here on top of a company that is starting to make that turn. As I stated, we're not out of the woods yet, but I would say this is a positive direction for Intel, which is now leading us to UPS. And this has been a very ugly chart, much like Intel, an extreme downtrend with a massive sell-off on huge volume here recently. The interesting thing is this, the CEO is saying that this move to get away from Amazon is actually beneficial. It's going to grow margins, and it's only going to impact top line revenue by 2 to maybe 3%. This could actually be better news for longer term investors, even though the stock is selling off. Now, this is a stock that's paid a dividend for 25 consecutive years, has raised those dividends as well for the last 15 years. The problem is becoming that payout ratio. It is a very high payout ratio, something to watch with this company. So what I did is I have them growing revenue over the next 3 years by 0%, saying that maybe this will impact them a little bit more than the CEO anticipated, and it might take a couple years before they get back onto growth of about 2 to 3%. So that's the story I'm personally telling myself. And I'm also saying that this hefty dividend could get cut in half. I'm getting a 9% rate of return when I'm looking at the equity, but I'm also factoring in total return. So if it has any sort of dividend here of 2% or more, I'm getting a double-digit rate. Now, if they're able to keep over that 5% dividend on this recent sell-off, then you have a pretty nice compounder, I believe, long term. Now, this is not going to be a get-rich-quick stock, but this is going to be a nice stock that should deliver double digits rates of return if you're able to get in at the right price. And $95 to about $105. I think if you get in at those levels, it is a pretty solid risk versus reward here. Now, the company reached 109 as a low yesterday, and it's still going red as of today. So maybe we see an additional 5-6% sell-off, and I think this is where you can start nibbling at the stock for a long-term hold in your portfolio. If somehow this 5.5% dividend yield can stay intact and they're able to keep margins strong, not lose a tremendous amount of revenue here, this is a pretty nice one to add in your portfolio that should be fairly safe, low beta, and have a nice growth rate going forward when dividends are reinvested. Now, of course, this is all just my opinion, but hopefully you guys enjoyed my dive into Intel and UPS, two stocks that I actually think are approaching pretty interesting levels. As always, ladies and gentlemen, appreciate your time, and we will see you all in the next one.